Hello from Hong Kong. My name is Eudora Wang, and I'm a Greater China correspondent for DealStreetAsia. Now, welcome to our virtual fireside chat at 2020 Asia PVC Summit. It's my great pleasure to welcome Jonathan Larsen, Chief Innovation Officer at Ping An Group, which is the world's largest insurer by market cap. He is also the chairman and CEO of Ping An's global Voyager Fund. I believe most of our viewers are already familiar with the fund, but for those who don't know, Global Voyager Fund is a $1 billion corporate investment platform of Ping An that mainly invests in the fintech and digital health areas. So thank you very much, Jonathan Larsen, for joining our session today.
Well, thank you, Eudora, for having me and, of course, for having Ping An on your session.
So today we're going to hear his insight into the growth of the fintech and digital health sectors, both of which we have seen an accelerated momentum as the COVID-19 pandemic is changing the way consumers access these essential services. And more broadly, where these industries and their investors are heading towards amid geopolitical uncertainties, and most recently after Beijing took a U-turn to bring in its own tech giants, including fintech firm and financial. So let's get started. I think I'd love to start the conversation with what you have experienced in terms of deal making this year, especially in your focused areas of fintech and health tech. How has been the capital deployment so far? Have you kind of positioned or adjusted your investment strategies over the COVID period?
Well, I think firstly, it's been a pretty good year for us and somewhat contrary to expectations. So I think before this session, we were just comparing travel notes, and I haven't traveled since the start of February this year, as I think is the case probably for most folks. And we had assumed that our inability to go and visit the markets where we typically invest would have really constrained us. We were fortunate to begin the year with a pretty good pipeline of opportunities that we were working on. So we closed a position in iCapital, which is a large alternatives distribution, administration, and diligence platform with BlackRock as its largest shareholder, and people like KKR and Carlyle as shareholders, and some distributors like Credit Suisse, UBS Wells as shareholders as well. So these guys have, I think, 9 of the 10 top alternatives players in the world as suppliers, and 9 of the top 10 distributors in high net worth wealth management as distributors. We were able to make an investment in that in February, so that was something that was ongoing. We invested in the health space in a very interesting company in Germany called Plus Dental, which we closed in May, which basically it's a invisible aligner platform, but it's a direct consumer business model version of that concept, and we think they can be the dominant European player in direct to consumer. They're already in 5 countries, doing very well indeed. We were able to get that done in May. We invested in a very good and very interesting trade finance platform called Taulia, based in San Francisco, also around about May, and we were able to do a couple of follow-ons so far this year in our investment in Better.com, which is the kind of leading all-digital mortgage player in the United States, which has just done extraordinarily well. So that's probably another topic for us to talk about, and as to what the effect of COVID has had and the acceleration of digitization. But that's a really good example of that. So we've been able to deploy. I think we're at about 120 million so far in the year. We've got a couple of things that might conclude before the end of the year if we stay on schedule. We typically, in our pacing for deployment of capital, we aim to deploy about 100 to 150 a year. So I think we're going to come towards the higher end of that range. And what we've found is that through firstly just being, I think, well placed coming into the year, but also through the ability to work remotely, use platforms like Zoom as we're using now, but also to use partners like McKinsey and our accounting firm partners to extend our reach where we need support on the ground. We've been able to get by. We still place a premium on physically meeting the people we invest in and physically visiting their place of business and actually looking at what happens where people are are working. But despite all of that, we've been able to remain reasonably productive.
Yeah, I definitely agree with you. Like face-to-face meeting are much better if we could do this offline event. So given your experience for the past roughly 11 months, what are the structural shifts in the PE and VC industry you have seen, especially in your focused areas, the fintech and digital health? Do you think investors will be, or they need to be, kind of re-evaluating their investment priorities when they are considering new investment opportunities?
Well, I think, again, I think our expectations have evolved through the experience of COVID. And coming into COVID, we were expecting, probably a pretty muted environment for funding. As someone that has funds and has an appetite to invest, maybe that's, in a perverse way, a good thing, because, it might imply lower demand and, more reasonable or accessible valuations. I think what we've seen instead is a bifurcation. I think if you're pre-revenue and you're still a concept company, for the most part, it's just much more challenging to attract funds. On the flip side, I think for companies that have, emerging and strong cash flows and, are sort of well on the path to emerging into profitability, there's very, very considerable appetite. And I think that's a function of the interest rate environment. I think also within the private equity world, of course, many private equity opportunities are well arbitraged and fully priced. And so we tend to see quite a few private equity firms moving down into the kind of growth stage sector. And then on the flip side, if you look historically, certainly the last 5-6 years, early stage venture returns, in some cases have been very good, but typically only for a very small number of firms. And I think there's a realization that investing in early stage is a pretty tough game, and you're really dependent on a few outsized winners in a large portfolio, and whether those winners are going to be there or not is, it's going to be a function of skill. It's also going to be a function of luck, and the reality is that there's a very small number of firms that are going to deliver those winners. So where we focus is in the middle, which is the growth stage, and I think that has a renewed attractiveness in the current environment.
Okay, so when we are seeing more players are kind of shifting focus on the growth stage investments, do you see there are increased competitions for deals in the growth stage, and potentially their valuations of those companies there are some degree of forthness in the valuation of these companies?
Well, there's no doubt whatsoever. There's been pretty frothy valuations evident from, sort of the late second quarter onwards. And we have a very simple approach. We tend to be very fundamentally driven in our assessment of companies. And typically we're trying to focus on companies that have meaningful revenue streams that typically in the sort of $30 to $60 million range. We're typically focused on companies that are getting close to or are at cash flow break even. And what we're really doing is funding the next phase of growth. And one way we articulate that is we're not really in the business of funding companies from 0 to 1. We like to take companies at 1 and invest in getting them to 10 or to 100. And that's what our capital is trying to do. So we tend to, as I said, take a pretty fundamental approach. Of course, we look at lots of reference points in the ambient market, but we always come back to, the plausibility of cash flow scenarios as one of the fundamental bases for valuation. And there are going to be times when we can make it work, and there'll be times when we can't. And there'll be other people who are just prepared to pay a lot more than makes sense to us. And that's fine. We're happy to let deals go when that's the case.
I see. That's very interesting. So I believe one of your focused markets is actually Greater China, and 2 major events recently happened in Greater China that have raised doubts about where the country's internet giants, including fintech companies, stand, which include the last-minute IPO suspension of Ant Group's dual listing earlier this month. So what about the impacts? Since I understand the Ping An also has its own fintech businesses, including Lufax and OneConnect. Do you think this and IPO's suspension could have some kind of influences to other fintech players in the market?
Well, there are certainly more well-informed people than I to comment on Ant Financial. But what I can say is fintech is extremely important to Ping An. And I think Ping An has been a pioneer in using technology in a transformative way and applying that technology to its traditional businesses in life insurance, in P&C insurance, in particularly consumer banking. And in all of those businesses, we have meaningful scale. And to give you an index just on the banking side that probably many people who look at Ping An don't focus on, the consumer or the retail bank is really coming into its own. And just to give you one little measure of the sort of the scale that we're now talking about is that Ping An Bank in the second quarter delivered credit card sales, meaning the purchase volume from our credit card customers. The aggregate was higher than Citigroup's number globally, and also Amex's number globally. So we're starting to see real scale in that business. So Ping An has been, I think, very successful in finding ways to deploy technology effectively to support its scale traditional businesses. Equally, we have, as you point out, businesses like OneConnect, which is our enterprise technology platform. And for the most part, what we're offering are platforms or technology products that we created to solve problems within Ping An or problems for our customers. And we've platformized those solutions, and we now provide them to over 600 banks and several thousand non-bank financial institutions, including most insurance companies in China. And really what the value proposition there is that many of these companies just don't have the technical expertise or the scale of technology operations to be able to compete with the big tech giants. And they then therefore look to someone like Ping An to be a supplier of technology services and platform services. And we see that business having an enormous runway into the future. We listed the company in New York in December in a very, very difficult capital market environment at the time, if those watching can recall what was going on in December. And I think subsequent to that, the company has achieved pretty good recognition and is now at a market cap of $10–11 billion, which I think is pretty good, given where we listed the company back in December. And then more recently, we've listed Lufax, and anybody that's been watching, this space for a long time would know that that's been in the offing or part of our plan for a very long period of time. That's also been pretty successful. I think if you turn to what's going on within the China regulatory landscape, I think what you're seeing is a general desire to establish common standards of regulatory supervision and capital and other protections across the financial sector. And I think probably one way to kind of interpret the Ant incident in a broader context is to think of it in that light. And I think that's probably a positive thing for China. I think having kind of a two-track or two-tier financial system has created issues. And I think the regulators are very concerned. They've said so publicly about systemic risks. We've seen the whole cleanup of the P2P industry, for example, as one category. In the wealth management industry, we're witnessing right now a fundamental transition from a kind of guaranteed fixed yield effective market to a properly marketized and NAV driven market. These are just two examples of a broader set of much more market oriented strategies on the part of regulators, but also the desire to have a level playing field. I think on balance, these developments are to be welcomed and will serve China's interests.
Understood. It's interesting you use the word, it's actually a positive change in regulatory framework in China. And you mentioned about the IPOs of Lufax and more recently, you mentioned about IPO of OneConnect and more recently the Lufax IPO. And we're seeing like fintech companies, including these two, they are more looking towards IPOs on the US stock market, whereas we're seeing back at home, we're seeing the IPO market in mainland are doing very well as well. So in your opinions, why are we continue to see companies, even though there's this geopolitical uncertainties, why we continue to see Chinese firms pursuing IPOs in the US market, especially for companies in the fintech area?
Well, I think particularly for companies that were originally set up with a, typically in a VIE type of structure with the intention of raising dollars and being funded by dollars, there's no doubt that the US market offers the deepest capital market in the world to access for investors or for issuers to access investors, and secondly, the most robust liquidity environment, and there's just no doubt about that. And I think the US will continue to play a very important part of funding, new enterprises in those jurisdictions around the world that permit that. China is certainly one of those.
At the same time, like Chinese big tech companies, including Alibaba, Tencent, and JD.com, they are increasingly looking to expansion to emerging markets, including Southeast Asia. Do you think Beijing's new regulatory frameworks in the fintech space will further promote Chinese big tech companies to shift the focus to opportunities elsewhere?
It could do, but equally, I think there'll be a focus on making sure that any expansion from financial companies is done in a prudent way. I'd say for Ping An, in general, our strategy has been to think of exporting our know-how and our technology, rather than making heavy asset commitments outside of China. So what we are trying to do, and I think what we are doing, is very capital efficient. One example I could point to is the expansion of OneConnect into Southeast Asia. So the business is based out of Singapore, but spans the region. And in the space of just 2 years, I think we've made tremendous progress and have built positions across quite a wide variety of financial institutions in the banking and insurance sectors across most of the countries in the region. So that's our strategy. I don't know what those other companies are planning to do from here.
Understood. And I want to take a more bigger picture question here. As Biden will become the next US president, there are professionals, they expect a less confrontational approach from Washington to Beijing. And in our conversation, I think September, you mentioned Ping An Voyager Fund mainly do non-control transactions in the US market, especially in non-sensitive areas as well. That's why geopolitical risks haven't been one of your concerns. I just wonder, with the Biden administration, do you think it will make more sense to more frequently look into opportunities in the US?
I don't think there's going to be much of a change from our perspective. I hope you're right, or the observers that you point to are correct, and that we have a more predictable and stable framework for the relationship between the US and the rest of the world, including China. That's definitely going to be positive for everybody if it materializes, and I think it probably will. So I think that's likely to be the case. Thus far, as you point out, I mean, we are invariably a minority investor. We're typically looking for 5 to 15 or sometimes 20% of a company. We have no desire to control the company. One of our fundamental criteria is the existence of extremely competent and experienced management. We don't want to have to step in and manage companies that are in our portfolios. That's simply not what we're set up to do. And we always invest for financial return first, and then on top of that, we invest only where we can find some path to creating unique value between Ping An and the investee company. So that's not going to change. Whether it's in the US or somewhere else doesn't really matter too much to us. We're not really driven by geography in terms of our targeting. We're much more driven by the sectors we focus on and the types of innovations that we're looking for. So thus far, as you said quite correctly, we really haven't run into any problems with the investments we've made in the States. And I think it is absolutely because we are focused on pretty generic sectors. We're not involved in sensitive technology. And we always make sure that it's very clear that we have neither interest in accessing nor access to any customer information that would exist on a platform in the US. So thus far, I think we've been able to operate pretty much without constraint, and we hope that that will continue.
So if that background really exists in terms of under Biden presidency, if China-US relationship can get back to normal or slightly better compared to previously, do you think for your fund, are you looking more into the US market compared to before? Will you do that?
I don't think this will change our focus. If there are good opportunities in the US, we'll invest in them. Equally, if they're in Europe, Israel, the UK, Southeast Asia, India, or even China, we'll invest in those as well.
Good. So apart from the tensions we're seeing between China and the US, we're also seeing this military standoff between China and India since May this year. And last time you mentioned the Voyager Fund only made one deal in India so far, which is in auto tech firm Cardeco, closed, I think, last December. Do you think the difficulty for investors to make deals in India will continue as we don't know when the pandemic will be over? And how important or attractive is India to global investors like Ping An, like especially in the areas of fintech and digital health areas?
Well, just to give the context, the investment we made in India last year was a company called Cardeco. And Cardeco is the leading car sales marketplace in India. We happen to own a company called Auto Home in China, which is also an NYSE listed company, and today has a market cap in the sort of $10 billion type of range. And we see Cardeco very much as the India analog of Auto Home. And we see an enormous amount of opportunity to transfer learnings from one platform to the other over time. And I think we've already set up a really good chemistry between the two platforms. I think obviously COVID has been an impact for car sales in all markets, including China, but certainly in India. The good news for Cardeco is they've diversified their business base and they're focused intensively on financial services in the interim period, and that's kept them going rather nicely. And as things start to stabilize, and it's probably too early to declare victory by a long way in India for COVID, because COVID's still a huge and escalating problem, but we're starting to see an emergence out of the COVID challenge. As far as the government to government stance and any possible restrictions on outside investment, we haven't encountered that yet. I think it's probably worth just recognizing that China is India's largest trading partner, and that's not going to change. And I think on the sort of economic side, there's a pretty constructive relationship.
Good. That sounds quite good. Another emerging market that we also focus is Southeast Asia. And recently we see the formation of the largest regional trade bloc, RCEP, I think in mid-November, which includes 10 Southeast Asian countries, as well as South Korea, China, Japan, Australia, and New Zealand. So with the formation of the new trade pact, do you think the opportunities in Southeast Asia will potentially increase? Because previously you mentioned it's quite difficult to make deals in Southeast Asia region because it's composition of so many different jurisdictions. Do you think that will change?
Yeah, look, I think the Free Trade Pact is a great initiative and is certainly likely to be positive to the economy is concerned. I think for Southeast Asia, I don't think that changes the reality of Southeast Asia. It's tempting to think of Southeast Asia as a kind of a United States of Asia in some ways, that it is not. It's a series of quite different individual markets, ranging dramatically in size, but also with very different political, regulatory, financial system and competitive landscapes. So each one needs to be dealt with individually. And there are very few examples of pan-regional platforms, even in the internet economy in Southeast Asia. So it's not an easy place to operate if you want to span the region with a single platform type of model. I think there are some really interesting markets. We continue to be interested in Indonesia, having spent a fair bit of time in different contexts working in and with Indonesia over the years myself and some of my colleagues here. We remain very interested in that market. As you and I have discussed before, what we tend to see in a market like Indonesia are models that have been proven elsewhere in the world, mostly in developed markets, being adapted. And the trick, if there's a word for it, of how do you succeed, is how to deal with the unique characteristics of that market and find the right product market fit and path to scale. Just given those characteristics. So, in the lending sector, the SME sector, the payment sector, there's a lot of interesting things going on. We continue to monitor Indonesia. We've yet to find an investment opportunity that we've wanted to progress with, but no doubt that will change.
I think it's interesting you mentioned you see Southeast Asia as more of a market of deployment or application of tech created by developed markets. And how will that work? Can you be more specific on, let's say, what kind of businesses that will interest you? How will the business operate in local market in Southeast Asia, but at the same time, it has the existing or mature tech from a developed market already?
Yeah, I think if you look at the e-commerce platforms in a place like Indonesia or in any of the countries in the region, and the interface between those and finance, and there are plenty of platforms that interface with e-commerce that provide loans real time, very much the way platforms like Ant interface with the Alibaba network or the Taobao platform in China. So you're seeing the analogs of those in places like Indonesia. What you don't see is the kind of single monolithic dominant player that Alibaba represents. You're seeing a much more fragmented or at least competitive market. And you're seeing a new generation of finance players alongside those players, usually who are not controlled by the e-commerce players, which is another difference between China and Indonesia. And then you see behind those sources of financing, which in most cases are still banks, but not exclusively. And we see this pattern in many markets around the world. And as I described earlier, what we're really seeing in Indonesia is an adaptation of an established model in the kind of Indonesian environment.
So can I understand it as Ping An is seeking to back players that are from developed markets into emerging markets in Southeast Asia, rather than startups developed from the local markets?
No, not at all. I mean, they're more likely to be local companies that have adopted or adapted models that have been successful elsewhere.
Understood. And last time you mentioned the consideration of rope in third-party LPs for the Voyager Fund that could potentially help promote the growth of portfolio companies of the vehicle. Any updates on that front? Are you working on? Yes?
Yeah, so over the last 3 and a bit years since we started the Voyager Fund, we've been approached by quite a few players who have expressed interest in investing in the Voyager Fund and kind of leveraging Ping An's commitment and expertise in this space. The good news is that the portfolio we've built so far, although we don't yet have any exits, despite that, the portfolio is performing pretty well, and the companies in that portfolio have done quite well in terms of subsequent round valuations but more importantly, underlying revenue growth. So I think we've thought about that quite deeply. We don't really need the capital. I mean, Ping An is not capital constrained, but we actually think it is interesting. And our initial focus in sort of picking up this idea and developing it has been to engage companies that we know who are typically peer companies in the insurance industry and who have a very similar strategic outlook to Ping An and who see value in teaming up with Ping An, pooling resources and leveraging the investments that we make. One of the things that we really like to do, even on our own account, is to invest in companies, typically B2B platforms in financial services or health, alongside top tier global investors who are strategic investors. So we find ourselves alongside people like Goldman Sachs or UBS or Credit Suisse or BlackRock, as I mentioned earlier, lots and lots of other top tier global financial institutions. And what we like about investing alongside those types of players is that every time you bring one of those players to the table, if they can be a user of the service of the company, the presence of that investor is instantly accretive to the business case. So we've observed that, and we try to position ourselves to take advantage of that phenomena. Of course, us ourselves being a strategic investor and looking to find synergy value ourselves. So our idea with the opportunity to bring in third-party LPs is to begin with a tier of like-minded strategics who can pool together with us and not necessarily in every instance, but in most instances, be a user or a partner with respect to the services that our investee companies are offering, and similarly be accretive to the business case. So for the companies we've talked to so far and the kind of indicative indications of interest we've got, that's a pretty attractive idea. So we're quite optimistic, although we're still pretty early in the process.
That's quite an ambition. Thank you so much for your time. We already ran out time for this session, but it's a great talk with you. I'd love to meet you again in Hong Kong offline in the near future. Stay safe.
Likewise. Thanks, Eudora.
Thank you.